All right, well, we're excited to have our good friend Avramis back in the room, and we're going to turn the time right over to you. Go ahead.
Hi Dave, thank you very much. So hi everyone, and welcome again today for some Fibonacci magic. This is actually my favorite subject. I'm really excited about whenever I teach it, and hope you have the same feeling after you see it. Okay, now before we start with some Fibonacci magic, I'm going to go through some basic entry signals that we actually covered last time, but understanding this is a vital part of understanding how you can then apply Fibonacci to project price targets. Okay, so bear with me and we'll get to the Fibonacci magic in a minute. So we'll be talking about the failure swing today, which is my favorite entry signal actually, swing trading. Then we're going to talk about number 5, Fibonacci retracements, Fibonacci projections in a different way than most of you are probably used. And then we're going to talk about Fibonacci exit signals. And then we're going to put it all together in a nice system that I call the trend reversal entry. Yes, not as exciting a name as the Fibonacci magic, but it is what it is. All right, so this is more or less my disclaimer. So you know that most successful traders agree that to make money out of this wonderful game that is trading or investing, it requires 3 things. It requires to have a method, a working system. It also, however, requires to have sound money management practices that go with these methods. And of course, the third aspect is to have the proper mental approach, to have the mind, to have the discipline to follow your method and stick to your money management. Yes, I'm sure you've all traded, and we've all been there at times when we didn't stick to one of the two, or sometimes none of them. So without any one of these key elements, you'll ultimately fail in these endeavors. Yes. So to make money out of this game, we need a method, we need money management, and we need the mind. It's Alexander Elder's 3 M's, right? And this is what is going to give us the ability to make money out of this game. Now, before we proceed, I would like to make 3 agreements with you. The first thing I want us to agree on is that technical analysis, which is the method that we use to predict the markets, is 100% correct. What do you think about this one? Do you agree? You can type on the chat if you want to. Agree? Oh wow! Yes, blimey, impressive. So it's good. I'm not kicking anyone out of this webinar. All right. So look at this. What I want us to agree on is that technical analysis is not 100% correct. Yes? Okay? So this is the first thing I want us to agree. Now, how correct it is, it's another story, but the first thing I want us to agree on is that technical analysis is not 100% correct. Okay. Now the second thing I want us to agree on is that technical analysis does not work in Forex and only works in S&P and equities. Definitely that's not the case. And the third thing I want us to agree on is that if you know everything there is to know about technical analysis, you will make millions. Well, of course, the answer to this is also no. Why? Not because you cannot do it, but because of the first condition, that technical analysis is not 100% correct. So what you need is the 3 M's. So today we are going to talk about technical analysis and a very good method of how to enter the markets, but we also have to add money management to it and have the discipline to follow this system to complete our way of making money from the markets. So today we'll be covering all three aspects in a sense, actually mainly the money management and the method. The discipline of how to do it, I leave it up to you. So look at this. As I told you, my favorite entry signal is what is called the failure swing, and it works like this. So I'm sure you are all familiar with candles. The market is going up, white candles, bullish, tralala tralala, everyone is happy, and then the market comes down with a few black candles, right? So when this happens, then we can go back and mark the highest point there as our peak, and this is our first top or peak. Yes? Okay. Now after we start going up again with mainly white candles, of course you see there is one black candle there, but on its own it's not enough to create a top or a bottom, and this is what gives us our first rule, our first indication of how to find whether something is a top or a bottom. In our case, to identify a peak, you need a minimum of 2 black candles. Yes? So that means that to identify a trough, you need a minimum of 1, 2 white candles. So where we are now, is this a peak? Don't think so, but after we see 2 black candles at least, then it definitely becomes a peak. Yes, Guru, 2 on the right and 2 on the left. I guess you are talking about black and white candles, yes? Okay, so to identify a bottom, we need at least 2 white candles and so on. So once we have 2 peaks and 2 troughs consecutively higher than each other, we have identified what in the books of technical analysis is called an uptrend, right? And once we have an uptrend, the most probable thing to happen is for this uptrend to continue to exist, meaning for the prices to continue going up. So when the market is like this, like we have it here on the presentation, the most probable thing to happen, what we expect the market to do, is to break the top and continue going up. And this can go on for a long time, as I'm sure those of you that trade the S&P know, yes? But at some point, we'll see this thing here. And what is this? This is the failure to break the resistance, to make a new high. So this is our first indication that this uptrend that we have now in existence is not as good as it was before. Why? Because as we said, the definition of an uptrend is higher peaks and higher troughs. So what happens here is the first time in all this uptrend that we have the failure to go higher. So we have a top here that is lower than the previous top, and this is what we call the failure. Okay, so once we have the failure to go higher, it's our warning signal that this uptrend could be coming to an end. But the confirmation of when the trend finishes comes when the price goes below the last bottom, because in that event we no longer have higher tops and we no longer will have higher troughs or bottoms. So once the market breaks the last bottom, which we call the swing level, this is what we consider the entry point to short this market. Okay, so the way we enter a market, shorting it, is when we see this formation on the chart. Of course there are many other formations, but this one is a summary of all of them in a sense. It could be the head and shoulders that some of you know, or various other formations, right? So when we see the failure to go higher and then the swing, and we swing in the opposite direction, then we have what we call a failure swing or a trend reversal to go short. And then most probably the market will go in a downtrend. And what do we expect this downtrend to do? To continue going down, because as long as we have lower tops and lower bottoms, then the downtrend is intact and the market is expected to continue going down. If now we see the failure to go lower, to break the support, and subsequently we see the swing by breaking the last top, then we have the opposite case, which is a failure swing to go long. Alright, so this is the way that we use this formation to enter the market, and you will see in a minute that it is very much related to the way we'll use Fibonacci today. So we can have a look at an example of, let's say, a failure swing to go long and a failure swing to go short by looking at the weekly chart of the S&P, which I'm sure a lot of you are quite familiar with. Yes? Okay, so you will observe here the market was coming down, top, bottom, top, bottom, top, bottom, then it went up, and let me make it more fun. So here, what was the most probable thing to happen? For the market to continue, let me remove this also so that it does not cause any confusion. So the market was coming down, tralala, tralala, everyone was short, everyone was happy, goes up, comes down. Then what is the most probable thing to happen here? To continue coming down, break this bottom here, and continue going down, right? Instead, it failed to go lower, and then it swings and breaks the top over here, in which case we have our entry signal to go long. So does anyone else have a problem with the sound? That's not good. Sound is good. Okay, so if you have a problem with the sound, maybe it's better to log out and log back in, and it should be fixed, since most of you seem not to have a problem. Okay, so continuing here we have the completion of our failure swing to go long, and we buy, and tralala, tralala. Now on the flip side, if we come here, over here we had an uptrend. Yes, we have a bottom, a top, a bottom, a top, a bottom, a top, a bottom. Market is going up, then it comes down. Yes, so it comes down here, and then it starts going up. So what do we expect it to do here? To break the top here and continue going up. Instead, what did the market do? It fails to go higher, and then we can be ready and we say that once the market breaks the last trough, which is this one here, then the formation to go short has been completed, and we go short at 1,400 and tralala, tralala, all the way down to 700. So this is the formation that I like to use when entering the market, and with the same logic you can use it on a weekly chart. We will see later more examples on the daily chart and on the lower time frames. Alright, so this is the one part of the equation. You see, we need a sequence of things to happen. So the first thing we need is to see a failure swing, either to go long or to go short. Once we have this formation, then we can proceed with the remaining aspects of the thing. Now, before we continue, this is our way to enter the market. Again, as I'm sure you know, there's many systems to enter the market, many ways to enter the market. This is my personal favorite. So we buy when we see a failure swing for up, and we sell when we see a failure swing for down. But you have to accept that in this business, we don't eat the head and the tail of the fish. What does that mean? It means that we will never buy at the bottom, and we will never short at the top, but we will wait for the failure to go lower, and we will buy at the failure swing over there, and we will never short at the top. We will wait for the failure to go higher and the swing over there to go short. Okay, so basically we don't eat the head and the tail of the fish. Yes, you know, I can tell you of a way to buy down here and short up here. You know, when I first started as a junior trader in a bank, we would go out with the senior traders, and they would all say, I bought here, I sold here, and you would look at them and say, oh my God, they are so good, I have so much to learn from them. Well, eventually I found out how they did it. Yes, shall I tell you? So basically, they bought here and 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 here, but they would only mention this trade, and they would sell here and here and here and here and here, and they would only mention this trade. Okay, so in my experience, we cannot eat the head and the tail of the fish consistently. Of course, it can happen many times, but you cannot do it consistently. So we don't eat the head and the tail of the fish. And now going back to the disclaimer and the agreement that we started at the beginning, not all, we have to be careful, because since we are not 100% correct, it means that not all failure swings are correct. So this takes us to the second aspect of our triangle, which is the stop losses in essence, right? So our exit signals are separated into two forms. One of them is, of course, the stop loss. Now, beginners look for promising trades, meaning promising entries, and assume that if they find them, that will give them money. Professionals, on the other hand, spend a lot of their time looking for take profit levels and stop loss levels. So our exit signals are the stop loss and the take profit. A stop loss, when you are using the logic I just showed you, so you see it's a sequence of events, is pretty straightforward. So tralala, market is going up, gives us a failure swing. Where do we place the stop loss? The stop loss, we place it above the failure level when we get our swing here to go short. And when we get a failure swing like here to go long, we place our stop loss again below the failure level. So until now we have completed 2 out of the 3 required elements of having a system. Yes, because to have a system, it means that it gives you entry signals and exit signals. And since exit signals, we have divided them into stop losses. The other missing ingredient is the exit or the take profit levels. And this is where Fibonacci comes into the picture. So Fibonacci is supposed to be the greatest European mathematician of the Middle Ages, okay? And he was one of the first people to introduce the zero actually in Italy. You know, before Fibonacci in Italy they were counting with the Roman letters I, IV, V, X, and so on. Now, in one of his books, he introduces the following problem. How many pairs of rabbits are created by one pair in 1 year? If it is in their nature, in a single month to bear another pair, and in the second month, those born to bear also. Okay, so let's play a little with the numbers to see, to get a glimpse into the magic of it. So we start with one rabbit, then another one, yes, male, female, otherwise it doesn't work. Then we have 2, then 3, then 5, then 8. Can you guess the next number? Next number is 13. Next one is 21. Next one is 34. Basically, we always add the last two numbers. Yes, very good. Excellent done. So 55, 89, 144, 233, 377 rabbits in 1 year. That's not bad. Should open a farm. So now look at how these numbers become magical. Now, every time you divide a number next to each other, 144 divided by 233, you get this number. Now, if you divide 89 with 144, again you get this number. And if you divide 55 with 89, again you get this number. So, of course, if we divide 233 with 377, again we get this number. Now I'm going to leave one empty in the middle and I'm going to divide 144 with 377. When you do that, you get 0.382. And when you leave 2 in the middle and you do 89 divided by 377, you get 0.236. Now look at this. If I divide 0.382 with 0.61, I get 0.618 again. If I divide 0.236 with 0.382, again I get 0.618. Now look at this. If I do the opposite, 377 with 233, I get 1.618. If I divide 377 with 144, I get 2.618. And if I do 377 with 89, I get 4.236. Now, if I divide 1.618 with 2.618, I get 0.618 again. And if I divide 2618 with 4236, I get 0.618 again. So, you remember Pythagoras from school? He said that if you have a straight line, AB, then there is a point on this line that is unique, one of a kind, not in the middle, a little to the right. You know why this point is unique? Because if you divide B with A, you will get the same number that you would get if you divide A with A plus B, and this number is 0.618. Now, you know in mathematics, the circumference of a circle is shown by the Greek letter pi. You know which Greek letter defines 0.618 and 1.618? It's the Greek letter phi, hence the name of the academy, yes? Okay, now look at this. Using this number, you can do two things. You can create a golden rectangle, and a rectangle, we call it golden when we divide the small side with the long side and the result is 0.618 or the number 5, then we have a golden rectangle. Or we can create a golden spiral. How do we create a golden spiral? A golden spiral gets wider or further from its origin by a factor of 5 for every quarter turn it makes. So if we divide G with F, we get 0.618, F over E 0.618, D over C, C over B, B over A, and so on. Now, do you know where we find this golden spiral? We find it everywhere, yes? Think about it. When you fill your bathtub with water and you take the tap out, how does the water go down? It goes like a spiral, yes? But that's not just any spiral, it's a golden spiral. Now look at this. The pyramids in Egypt are based on phi, and of course Parthenon is in Greece is a golden rectangle. Now what else? This is a spiral galaxy. Well, I didn't measure it, but from what they say, it's a golden spiral. Now they say that the people who we consider beautiful, they have the ratios of the Fibonacci numbers in their faces or in their way their body is built. And finally, this is our DNA. Well, our DNA is made up of 21 by 34 atoms, making a very close golden rectangle. So now, phi is everywhere. And you think we cannot find it in the markets, which is full of human psychology? Let's see how. Let's say my friend Andreas, he bought this share at 10 and sold it at 20. Doesn't matter why, yes? So when it comes down to 10 again, what will Andreas want to do? He's going to want to buy again, yes? So 10 becomes a support level. And when it goes to 20, what will he want to do? He will want to sell again. Thus 20 becomes a resistance level. But the second time he's doing it, he's out with his friends, enjoying himself, and he's telling them, I bought this share at 10, I sold it at 20, I bought it at 10 again, I sold it at 20, and I'm at the table next to him telling him which share, share, blah, blah, blah. Now, the next day he wakes up, he's going to go home and say, oh my God, I told everyone about my share. So everyone is going to go and buy before I do, and the market will never go to 10 to buy. So what do you think he's going to do? He's going to buy somewhere there before 10. Do you know what this number is? It's the 0.618 of the move from 10 to 20. So 10 times 0.618 gives me 6.18. 6.20 minus 6.18 gives me the most probable level for him to buy, which is 13.82. But today we are not going to focus that much on this way that Fibonacci is used, the Fibonacci retracements. We are going to focus on a way of projections. So you remember the opposite ones, the 161, the 261, and the 423.6. Do you know where he's going to most probably want to sell? He's going to want to sell at the 161.8 of which movement? Of the movement from 20 to 13.82. So how much is this distance? It's 6.18 times 1.618 equals to 10. 13.82 plus 10. The most probable level for him to take his profit is 23.82. If he doesn't take the profit there, the next probable levels are the 261 and the 4236 of the movement. And here is the magic part. Do you believe me? So choose any instrument that we have on Metastock and I will show you how it works. So come on, someone please type an instrument for me. Any instrument you want. Just tell me also the code. Huh? Alright, Bill, FXE, can you tell me the code please? Okay, Euro is standard and easy, but that FXE, I've never seen this instrument, so I don't know what it is. So let's keep those instruments down. Let me show you how we use it on the S&P that I have here, and then we'll go, oh, FXE is Euro USD? Really? In which word? Alright, let's look at S&P and Euro dollar then. So look at this. Now, let me show you how it's done. Now, so the Fibonacci, when we have an upswing, we draw it always opposite to the swing direction. So in an upswing, we will put it from the last top to the last bottom. Now, in a downswing, you draw the Fibonacci from the last bottom to the last top. So look at this visually. So tralala, tralala, the market is coming down, yes? So then it comes down here and then it starts going up. So what did we agree? We agree that when the market breaks the top, we have a failure swing, we are going to buy, and we will put the Fibonacci from the top to the bottom, and we are going to find the 161, the 261, and so on. And this is a possible level for us to take our profit. Now, when we are going up and we have a swing for down, then we will place the Fibonacci from the last bottom to the last top, always from left to right, to project 161 and 261. Okay? So, if we come here, for example, and we go a bit further back in time, so the market is going up, yes, tralala tralalo, everyone is happy. What happens here? We fail to go higher, correct? So where would we enter? We would actually enter at this point here, and our stop loss would be that point up there. So by using the Fibonacci, it automatically puts for you your entry level, which in this example was around 1430 to be more exact, yeah, 1430, and your stop loss, you would place it at 1470, and your first target would be 1405, and your second target would be 1365, and the ultimate target would be 1300. So what happens in the market here? We short, oh my god, and it's going up. What do we do here? We panic and we close our position, yes? Or we keep it because our stop loss is up here, 1470 something, right? It didn't hit our stop loss, and look what happens when it reaches our first target. When it reaches the 161, then the market bounces and goes to our entry level, and it then continues to reach our 261, which is our second target, and then reverse and go higher. So let's say that we closed our position at the 261, yes, okay. So after we close our position, where would we go long again in this market? We would go long again in this market when the market went up, came down, failed to go lower, and we would buy above this level here. So I'm trying to grab this Fibonacci, but for some reason I don't seem to be able to, but we'll put another one on. So from here to here, and I'm going to change the color. Okay, I guess I can. So from here to here, so we would enter at 1450, more or less, 1447, put our stop loss at 1397, and our first target would be the 1480. So what happens when it reaches the level? It reached the level and short straight through it, and then our next target is the 1530, which was reached over here. And do you see what happens when the market reaches our 261? It corrects lower and then goes up again, right? So what you could do is you could buy again when the market breaks the high, let's say, okay? And when it reaches the 161, look again what happens. The market corrects, and then it reaches the 261, and look at where the market finally found a top, at the 423.6 of that movement, yes? But if we also add another Fibonacci to this movement here, okay, I want you to see it should be a bit lower. For some reason I can't select them to delete them, but I want you to see that both Fibonaccis from both moves were pointing around the 1680 to 1700 area as a very strong resistance level, and this is where the market has stopped. Okay, so let me remove now the line studies and look at where we are now. Yes, so the market came down. All right, now it went up, then down, got you in. So over here we had a failure swing for up. It hit your stop loss over here. Remember, we said technical analysis is not 100% correct, and now what this means is that we can ignore this internal swing and we can say that if the market breaks this bottom here, which is actually just getting ready to do now, then just done it, then we will have a failure swing to go short, and our first target is the 1565 and our next target is the 1505. So at this point we have a trend reversal to go short, targeting 1565 and 1510. Okay, so this is how we can use the Fibonacci to find our targets. And now going to the euro. No, let me remove this expert advisor. Okay, so what do we have here? Again, the market was coming down, starting from this part. Yes, then it went up here, came down here, failed to go lower, and then it gave a swing to go long above this level. So we can take our Fibonacci from here to here, and our target for this swing is the 135 level with our stop loss down here. Now if we go to the previous swing that we had down here, we can put our Fibonacci from here to here to see where the market is expected to find resistance. You see what happens at the 161, and when the market reaches the 261 of this movement. Yes, and we can also draw this Fibonacci. You see, I'm putting the Fibonaccis on all the swings. So you see, it was telling us that around the 135, 35 and a half, we had a very strong resistance. It overshot it a bit, but then it came all the way down. Now, another very interesting case that we had very recently, is the gold, and actually the gold on the monthly chart, you know, monthly being the most important time frame. Yes, so you see, again we were going up, came down, okay, then went up, failed to go higher, and once it broke the 1520, it gave us a swing to go down. It reached its first target actually in April when it broke down, and now our next target is the 1100 area. Okay, now before I complete the presentation and we move to the Q&A session and look at some more examples, I'd like to complete the whole thing, because you are thinking, where do we close? 161, 261, 423.6, where do we close our position? So look what I suggest. So let's put it all together. So the market is coming down, tralala, tralala, goes up, comes down, completes our failure swing, we buy there, this is our entry level, we put our stop loss over there, and then we put the Fibonacci. From where do we put the Fibonacci? We put it from the last top to the last bottom, and it finds for us the 161 and so on. Now when it reaches the 161, you can close 50% of your position, because we don't know, is it going to stop at the 161, 261, 423.6. Now there is a way to know whether it's going to reach the 423.6, but we don't have time to discuss it now, so I'm making it a bit simpler and making everything the same. So close half the position at 161, and then what do? Then you can move your stop loss higher to where? Well, there's two main points where you can place it. You can place it at the entry level, which means that if the market comes down and hits your trailed stop loss, you will lose 0 from the second position. You made some money on the first half. Overall, you made money. However, many times the market will come down, hit your stop loss, and then continue higher. So another place to put the stop loss would be the break-even point. Break-even point means if from the entry to the 161 I made 10 points, then I subtract 10 points from my entry, and this is where I trail my stop loss. What does this do? This has this effect. You make 10 from half, lose 10 from the other half. Overall, you lose nothing from this trade. Yes, you don't make money, but also you don't lose money. Okay? And then hopefully the market will continue and reach the 261, where you can close the remaining 50% of your position and then wait for another opportunity to enter the market. On the flip side, market is going up, tralala, tralala, everyone is happy, fails to go higher, breaks the last bottom. So this is our entry level. We place our stop loss above the failure level. Fibonacci from last bottom to the last top, finding the 161 where we close 50% of our position. We can move the stop loss lower, either to the entry level or the break-even level, and then we pray for the market to reach the 261 instead of hitting our stop loss, where we can close the remaining 50% of our position. Okay, so in a nutshell, this is a simple, but believe me, a good system that has positive expectancy. Yes. Okay, so it has an entry level, it has a stop loss level, and it also has targets. This is what the anatomy of a good system is. Okay, so before we move to the Q&A, in this example that we have here, we would go short in April at 15.20, then we would close at 13.50 half our position, move the stop loss from here. Where could we move it? We could either move it to the entry level, yes, so if it hits us, we will have made how much is that, $150, $170 on half the position. Or we could say, where was the entry? 15.20. How much did I make? 170. So 15.20 plus 170, we would place the trailing stop loss at 1670, meaning that if the market would hit our stop loss there, we would make 0 from the total trade. And now what happened then afterwards? It didn't hit either of the trailing stop losses, and now we are targeting the 261 to close the remaining 50% of our position. All right, good. So let's go to the Q&A session. Alright, multiple attendees are typing, so let's see. Which time frame? Very good. I was expecting this question. Excellent. Okay, so let's go and have a look. Hourly, yes? Oh, this was a nice party today. Alright. So let me remove this character here and let's see what is happening. So what was happening here? Let's see what happened today. Yes, so today, well, actually we didn't have a failure swing because the market was going down. It came up, but still you would short below this level here. Yes, so you go short there, you put your target there, 161, 261, you close your position, and then the market continued all the way down there, and you hate yourself, right? Why? Because this was actually a move from another time frame, from a higher time frame, and you could say use the 5-hour time frame. Yes, okay, so if you go to the 5-hour time frame, then you would see that the entry was this one over here, and as you will see, 161, 261 and 423.6 will be reached soon. As I told you, there is a way to know when it's going to reach there, but come on, don't be greedy. 161, 261 is more than enough. Okay, so if we go to our other favorite instrument for the day and we go again to the hourly, the only difficult thing when you go to the lower time frames is your ability to identify the correct tops and bottoms. Yes, okay, so what happened here yesterday? Well, actually from down here the market was starting to go up, right? So you had a swing here, you would put your Fibonacci, and look, when it reached the 261, the market went into a range. No, pay attention, sorry, it's not the projection we use the retracement, but it depends on how you use it on the trade. Yes, okay, so again here you notice another swing in the market, and you see how once it reached the 161, the market stopped for a while, then it reached the 261. Yes, okay, and then what's happening here? It became a range again, and this is actually the problem with the lower time frames, right? And then a range again. So what changes in the lower time frames is that you need more tools to help you filter the swings, and actually more experience to be able to identify the correct swings vis-a-vis the ones that are not. But in essence, it works as good in the lower time frames as it would on the higher time frames. So look at this. How about even on the hourly, when you see what we call the perfect picture, which means you have an uptrend and then you have a good failure swing, then by all means go and trade it. It will work as good as it works on the higher time frames. But as in everything that you use, the higher time frames, the moves are clearer on the higher time frames. Yes, you see, it's much easier to find the bottom and the top. Yes, okay, so it doesn't need much experience to find the bottom and the top. So you see, the trick is actually the first seminar we did last time, which shows you exactly how to identify the correct tops and bottoms. Yes, but as a rule of thumb, go for the clear ones. No one doubts that this here is a top and this is a bottom, right? So you see how the Fibonacci works. Of course, also over here we had a top and a bottom, and you see the market went to the 161 and then it hit both your stop losses. I mean, even if you put it at the entry level or at the break-even level, it would hit your stop loss, but again, you didn't lose money from this trade. All right. So would you also use indicators? Yes, Adriel, exactly. No, not to take your profit. Yes, you would use it to filter which are the good failure swings in the lower time frames. Just talking about time frames, because you're absolutely right, is one of the most important things. Look at this on the weekly chart. Okay, I mean, let's take the euro for example forever. Let's take it for the period that I have here. Okay, there is practically maybe one failure swing that does not reach at least the 161. Yes, so you see, if you put this at the correct level, yes, you see 161 comes down, 261 the market crashes. Okay, again then we had another failure swing here, definitely the market 161, 261, and after that the market goes down. So again you have a swing here, 161, 261. You understand what I'm trying to say? It's very, very difficult to have a fake failure swing on the higher time frames and more easy to identify them. As you go to the lower time frames, yes, as you see, it becomes, there are more ranges and it becomes more difficult to identify the correct swings and the correct levels to enter the market. And this is where I would recommend using indicators and oscillators to filter which are the good failure swings. Well, Bill, it's used the same way. I don't see it working differently. As you saw, we used the euro and we have also the S&P, yes? Okay, nice trade today. So even on the weekly, for example, of the S&P, which was the first swing to go, look at this, let's follow it again very quickly. The market is going up, comes down, Fibonacci from here to here, 161, 261, you close your position, then again entry here, 161. If you had it at entry level, you hit a stop loss there, but again you didn't lose money, 261, and so on. And the last swing we have is this one here, and look where it is targeting, exactly where the market topped. And if we take also the previous swing, again you see that here we have two different swings that were telling us 16, 70, 80, 90 was a strong resistance. This is a way to know what to close more or not. Rick, no, I have never used Fibonacci time zones, period. Not successfully. I just never used them. Okay, so if you trade with different time frames, a 261 would be 161 in another, depending on whether you get the correct tops and bottoms. Yes, it would be exactly that. Okay, so if we go to the S&P, now pay attention, the S&P is in a clear uptrend on the weekly time frame, yes? That means that it's going to correct lower to then continue higher. However, on the daily chart, since this is our swing, if you like, is the bigger one that we got today is this one here. So if we ignore this, the market did this in essence. The market came down, it went up here, yes, and today it broke the level here. So our target, so today it takes us short, and our first target is the 1565 and the second target is the 1510 with a stop loss at 1655. So this is the targets for the S&P on the daily time frame. Of course, you can have a look at the hourly time frame as well, but actually my favorite time frames are 4 hours and higher. Yes, I'm an old man, but even with this small swing that you had here, you see 161, you close your position, and the other one closed either at entry level or at break-even point, and you saved yourself. When the market was going up, tralala tralala, comes down, then starts going up, fails to go higher, so you say, okay, once the market breaks this level here, I'm going to short at 1635, I'm going to put a stop loss at 1675, and these are my targets. Target 1 reached. Then if you put your stop loss at entry level, it closed it. If you put it at the break even, it didn't hit the stop loss, okay, and you are still waiting for the market to go down, but actually you would probably have closed it here on this failure swing to go long. But the hourly guy's target is now 1575 more or less. Adriel, the Fibonacci manually you would calculate it as I explained in that example with Andreas. For example, what you do is you would measure the distance from here to here and multiply by 161 and 261. But come on, you have Metastock doing it for you. Why would you need to do it manually? Yes? Alright, so this is the idea. Now, again, remember that as in everything in technical analysis, the clearer the picture, the more the probabilities are of getting it right. So instead of focusing only on the euro, what I would suggest is you use the scanning abilities of Metastock to go and scan all the markets, all the instruments that are ready to give you a trend reversal, a failure swing, right? And then go and trade those, and now you know where you should place your stop loss and where you should place your take profit. So, thank you very much for today. Now, this is my email. If you have any questions, by all means, feel free to send them to me. I'm flying to Abu Dhabi tomorrow, but I'll get round to my emails and I will reply to you as time goes by. So, hope you enjoyed it. Okay? And hope to talk to you very soon.
Thank you so much, Avramis. What a terrific presentation. I can definitely tell from the participants here. It was very well liked from everybody. We will definitely keep you in the rotation, and I'm sure our customers will appreciate having you back in the webinar room soon. Thanks, everybody. Have a terrific rest of your day, and best of luck in all you do.
All right, thank you very much. Bye-bye, everyone.